Would I invest in Alphabet, the parent company of Google and YouTube? Don't clip this. This isn't advice, but yeah, absolutely. Would I invest in Nvidia? Yes. Would I invest in HIMS? No. Would I invest in Oracle? Absolutely not. And do you think that I was surprised when their company laid off 30,000 employees like overnight the other day? No, I wasn't, because I knew that their debt usage was off the charts. Hi everyone, my name is Sarah. Welcome back to Small Street Bets with Sarah, where I go over slow, consistent, and steady strategies that I use to make profits in the stock market. And this is not financial advice, but I do hope that you're entertained and learn what a normal working girl is doing with her extra funds in her brokerage account. Today, we are going over the ratios that I use to choose stocks for option selling. There are a few financial ratios that I use to make sure that I'm selling options on stocks that I am for sure willing to own. And if you want to learn more, let's get into the video. So what numbers am I talking about? What numbers do I speak of? Well, I can never memorize them because I don't have the memory of a genius, okay? I have the memory of a very regular person. And so I have a cheat sheet that I made for myself here. I wrote it down, but also I made a beautiful visual that I will attach to the video and share with you, because this cheat sheet is what I use to understand if I want to invest in a company or not. It's a quick snapshot of what's happening financially, not advice. However, these ratios are a current ratio of 1.5 or greater, a debt to equity ratio less than or equal to 0.5, and return on equity greater than 8% for the last 10 years. Bonus indicator: good management. It can be hard to find if a company has good management or not. There is word of mouth, there's things that are posted on the internet. There's also something called a Great Place to Work list, which is by Fortune. It is a list of 100 companies. There are both public and private companies on the list. I've worked at companies before that have been on that list in the past, and I know how hard it is to make that list. And so there is this idea that if a company is great to work at, then the people will stay, the people produce greater outcomes. And so there was a study posted by Great Place to Work. I do believe that this was their study, so this is absolutely biased, but they said that companies that are on the Great Place to Work list report 8.5 times greater revenue by employee. So while that could be a biased study, it does make sense and common sense that companies would do better financially if their greatest asset, which is their people, tends to stay with them and likes to work for them and do good things for them. If you wanted to hop out of this video and calculate these ratios on your own companies that you're thinking about investing in, have at it. However, if you want to learn the behind the scenes of what's going on with these numbers or where these numbers are coming from, then hopefully stick around. I'm not going to just post a video about the ratios that I use without the knowledge that backs them up. It is my bias that these three ratios indicate what's going on in a company as a whole in one snapshot. I had my master's of business a couple years ago, and my first class was accounting. I was so nervous for that class because I did not like accounting in undergrad. Debit and credit, literally, what are we talking about? Never really resonated with me until I understood how I could make a profit with this information. So, are you ready? So current ratio looks at current assets and current liabilities, and both assets and liabilities for a company can be found on a table called a balance sheet. I really like to think of assets and liabilities in this way. A balance sheet shows us what a company owns, its assets, versus what it owes, its liabilities. So the balance sheet, as well as other things like income statements, are going to be found on a company's annual report, and public companies that are traded on the stock market are required by law to have these reports posted. So the only thing is that these numbers can have a little bit of a lag, because you're not going to be able to see the current balance sheet for the current month unless you have an in on the company in some way. So you'll have to wait for earnings, or you'll have to wait for the annual report to be posted. So let's talk about what current assets and what current liabilities are. So current assets are going to be things like cash or things that could be quickly converted into cash, or things that are expected to be converted into cash quickly, like accounts receivables. So accounts receivables are basically contracts coming in from customers. So you have a contract with a customer that they're going to pay you X amount of dollars in the short term. And then current liabilities, I like to think of those like bills. So sometimes I'll talk to nonprofits and I'll say, oh, like you decrease your debt in half. What did you do? And they're like, I don't know what you're talking about. We didn't have debt. Because sometimes when people think of debt, they're thinking of long term, they're thinking of mortgages, they're thinking of long-term leases. But liabilities or debt in terms of this is also your short term. So let's take a look at Pinterest. This is going to be our example. And Pinterest is a kind of give or take on some of these ratios. So I'm going to give you my opinion with each of these. So I was able to get their latest, which right now, as of the middle of April, that was Q4 2025. And their next recent earnings will release on May 4th. So that'll go live pretty soon. However, their most recent data shows us that they had current assets of about 3.5 billion and current liabilities of about $500 million, giving them a current ratio of 7.64, which this seems really high and seems really great. However, when we look at the other ratios and we look at the full picture, I personally think that hoarding of cash can be sort of a negative thing. Again, I'm not an expert, I'm not a professional, but I just think, in my opinion, that Pinterest has a ways to go in terms of marketing themselves to the new generation, and they don't get as much screen time as they do other applications on our devices. And so I think that Pinterest really should be spending more on research and development rather than just hoarding their cash. But that's just an opinion. So next we're going to look at two ratios that have to do with equity. Now, equity is a confusing concept for me. I'm not going to lie to you guys. It's confusing because what the heck is equity? I'm not a CPA. I'm not a licensed financial person to tell you exactly all the ins and outs. However, I like to think of it as what the company would be left over with. So its value if it sold everything it had, all of its assets, and it paid off all of its debts. Sometimes you'll see things on the equity portion of a balance sheet like paid in capital. So this would be what external investors are pouring into the company. You also can have equity in things like the initial IPO of when a company goes live. That money can go towards the equity of a company. What I do know about equity, okay, obviously I'm not an expert, but what I do know is that I want equity use to be higher than debt. I really don't want to see debt usage be skyrocketing high above that equity amount. That really becomes a red flag for me. So the debt to equity ratio is total liabilities divided by total shareholders' equity. And the idea is that it's lower risk for a company to be funded with greater amounts of equity than greater amounts of debt. So it can be considered healthy for a company to have a debt to equity ratio of less than or equal to 0.5. So when we take a look at Pinterest, again, both of these numbers are going to be found again on that balance sheet. We see total liabilities to be about 750 million. So we're not just looking at short-term liabilities anymore. We're looking at total. So long-term liabilities can be things like long-term leases, sometimes mortgages if someone is paying off a building, or loans that are long-term. And then also on the balance sheet, we see a total shareholders' equity of about 4.75 billion. So this equates to a debt to equity ratio of about 0.16. So super low, seems great. And this is also attributed to how low Pinterest liabilities are as a whole. Lastly, let's talk about return on equity. Of that equity, the intrinsic value, in my opinion, don't quote me, of a company. Are they able to generate appropriate income with that? And so this Warren Buffett inspired rule I like to use is net income divided by shareholders' equity that is greater than 8% for at least 10 years. So Pinterest has not been around publicly on the stock market for that long. So we don't have 10 years of data, but in this most recent year, we would use that 4.7 billion again for total stockholders equity. And then for the net income, we're actually going to get that from a different sheet than the balance sheet. That's going to be on your income statement. Pinterest used a funny word for it. They called it results of operations. Just their way of saying income statements. Sometimes companies will have different ways of wording their tables. Their net income was listed at around 416 million. So when you divide this by total shareholders equity, that gives us about 0.087. If you move that decimal point to the right, that gives us about 9%. So why would I not invest in Pinterest in terms of selling options after looking at these financials? I just found that their was a little bit too volatile for me. There's some years that are really, really high, years that are really, really low. So I would like to see them use some of that cash on research and development, try to appeal to upcoming generations. I just wonder if they could do better because they have so much cash on hand that they're not using. So for my strategy for small street wheel strategy, I want to be really, really careful and really confident that I can turn a profit on my investment. So far, that's really meant that I've only really traded on NVIDIA in my options account. NVIDIA just, they have good numbers. They're on the great place to work list. Google, I have done a little bit, but Google just, to me, stays above my price range. To be honest, it just stays out of my budget. Saw great things when I did my research project on them a couple years ago in my MBA, and still seeing good things now. So if I had the budget, probably would sell some puts on Google. I'll have to take another look and see if it's going to be a part of my upcoming strategy or not. So why would I not invest in HIMS? HIMS is one that I've heard my teachers talk about, my stock options teachers, the people that I've learned about trading stock options the most have talked about trading options on HIMS. And when you look at Q4 2025, their most recent earnings report, their current ratio was good at 1.898, but their debt to equity ratio was 2.98, and that's just simply out of my range. And their return on equity average since going public is negative 7.2. Now, I understand that their return on equity has been really great in these past couple years, but that's just not good enough for me whenever your debt to equity ratio is that high. When you have too much debt on the table, I personally think that's too risky. So I understand that they could be the next big thing, but then you see certain things come out in the news and the stock just tank. And personally, I'm really happy that I did not sell options on this and that it's not part of my portfolio, because I just need more of a proven track record. It's just my personality when it comes to selling options. Personally, I'm not looking for the next big thing when it comes to selling options. If I was doing that, I might buy a few shares. But when you're dealing with a contract of 100 shares at a time, I'm just not here to play a game of risk. I already have enough risk going on in terms of how much money I'm throwing onto the table. So Oracle, I said at the beginning of this video that I wouldn't trade options on Oracle. I wouldn't invest in Oracle. And why is that? Well, their current ratio, according to their last filing, was 0.75, which is, pretty low. But then here's where we get really crazy. Their debt to equity ratio was 7.029. You guys, this is beyond. And I think it's unsustainable. It did not surprise me or shock me at all whenever certain things like 30,000 layoffs come up in the news that happen seemingly overnight. It's just really not a shock to me, because when I see a number like this, I just simply see you're trying to do too much. And so I have to wonder if there's other things that could be done, like decreasing expenses, maybe improving products, improving the return of experience for each customer. What's going on that Oracle is spending so much money to try and keep up? with its competitors? I don't know. I don't know the answer to that, but I don't want to know. I don't have time. I'm not interested. I just know I'm not touching it. That super high debt usage is also seen in its return on equity. Its return on equity looks incredible, but again, when something's so inflated, you have to ask yourself why. So also, this could be because they simply don't have a lot of equity, you guys. So they're funding everything with debt. Like, there's tea, you know? There has to be tea going on. I know that people get into PE ratio, and there are amazing ratios that help us decide if a company is over or undervalued. You could look at RSI, but these are still my tried and true fundamentals. And this is where I start when I'm thinking about investing in a company individually with stock options. And so I want to thank you guys for sticking around to the end of the video. And because you made it to the end, I am wishing that you become a millionaire. And I'm wishing that you have amazing financial success in your lives and in your family's lives and in your friends' lives, and that you become educated and financially free. And I'm just wishing you the absolute best. Thank you so much for being here. This was Small Street Buzz with Sarah. See you guys in the next one. Bye. Okay, so I tried this mic because it's so cute, and my outfit is adorable, and I dressed up my very best because, hello, talking about financial ratios is very important. Hi, guys. Oh, I thought it was my cat, just the squeak of the chair.